This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have a frightening new report that proves the hard landing has started, and we're going to show you why it's going to get much worse. Now, you'll notice we're starting the show out in front of the U.S. Treasury building. Well, let's head inside to check out their latest report. And here you can see the monthly Treasury statement just was released this week. It has the receipts and outlays for the total U.S. government for the fiscal year 2023 all the way through June 30th. Well, check this out because what you're about to see is outright staggering. When we look at individual income taxes in Table 3, I want you to point out that what we're seeing here is the current fiscal year to date is $1.693 trillion, comparable to the period to date of last year. At this time, it was $2.135 trillion. That, my friends, is a 20% reduction in individual income taxes throughout this period this year compared to last year. And that is a staggering number. That's not just a 2% or a slight drop. That's a 20% drop in income. So as we talk about people spending in the economy and have money to not only make their debt service, but to go out and spend in the discretionary side, what we're now seeing is they people have 20% less income on average. So what does this mean? Is it just a matter that perhaps there was a slowdown last month and maybe overtime hours got cut, or what's going on here? Because we've been noticing that there's been a steady increase in wages. Even though wage growth is slowing, it's still increasing. So why are we suddenly seeing this drop off in income tax? Well, it all comes back to the pandemic stimulus money. Remember, we've been talking about, we've been hearing from experts, there's still money in savings accounts. Well, this is the first evidence that shows perhaps that money is now gone. And let's take a look at this next chart so you can really see the effects of all that pandemic stimulus on the economy. Here we're looking at federal government current tax receipts. Now, this is quarterly data, so we know that it's come down even more, but look what happened. I've got kind of a crudely drawn trend line here in red, but notice what happened after the pandemic as money flowed out of the government from big, massive borrowing programs and giving it away to consumers and businesses. And what happened? All of a sudden, current tax receipts shot up. Now, the question here is, was this due to just a one-off event? And the answer is absolutely, because we don't have any further stimulus from the government to sustain it. Now, the hope, what Keynesians believe, is if you overstimulate or really come in and aggressively stimulate economy, that you raise the bar up to another level and it becomes sustainable. Now, what we do know in history is that's not true at all. Once that stimulus goes away, the economy has to reset back down. And now the concern is, let's go back to this chart and see it's got to come all the way back down, perhaps to trend, maybe even below. So the fact that we're now seeing all the way through this part of the year a 20% reduction in individual income tax, this starts to tell us why we're seeing the economy slow down. This is why here I'm in the vacation capital of the world. I've noticed there's a slowdown. The parks aren't as busy. There's restaurant reservations that you couldn't get before that now you can kind of get. People aren't spending the money they used to, and we're hearing that in the survey data. We see that in the factory reports. We're hearing that from the small business report saying that consumers aren't out spending like they were, and all of a sudden this is posing a huge red flag because a lot of people don't understand why the economy is slowing. Well, the simple answer is everything to do with the fact that now it appears the stimulus money is gone. And yet we turn over to the banks as U.S. bank earnings poke holes in popular recession theory. See, nobody actually believes that we're going to have a recession. They're looking at all the data and saying, look, it hasn't happened, so it's not going to happen. Maybe the Fed did pull it off. Maybe for the first time in history, they got it right. They're bringing inflation down. They're not going to cause a recession because the labor market is strong. And what the evidence is showing, and I've got a whole bunch of charts we're going to look at here in a little bit that shows that the pandemic money is now gone. That's what's been driving the economy. And now all of a sudden, due to inflation and higher debt loads and the cost to service that debt due to higher interest rates, consumers now have not only less money to spend on the discretionary side because now that their incomes are coming down, they're going to have a whole lot less. The conventional wisdom, at least in some corners on Wall Street, is that banks borrow at short-term rates and lend long. Now, this isn't conventional wisdom. That's exactly how the system works. So when you see that, it's kind of baffling why they would say due to conventional wisdom. No, this is exactly how the commercial banking system works. So when the yield curve turns upside down, it squeezes lender margins, which it does because they're unprofitable. If they're borrowing at short term and short-term rates are higher than long term, they don't make money, and it leads to a credit crunch. So what I want you to see in this article is the setup by saying, hey, look, the bank earnings were okay, but this inverted yield curve that everyone says is a recession indicator, look, it's massively inverted. In fact, it's more inverted almost since any time since the 1980s, and it's getting more inverted, and it's not causing a recession. And what I want you to understand is this everything to do with all this pandemic stimulus money that now appears is no more. Yet nearly 16 months after a key part of the Treasury curve first inverted, business at the big banks is booming. While the Federal Reserve's aggressive rate increases helped topple some regional lenders, JP Morgan posted a record profit, and on top of its rivals signaled stronger than expected earnings from lending. Instead of being doomed by an inverted curve, Jamie Dimon and his fellow bankers are benefiting from higher rates. Now, part of the reason they're benefiting from this, and anyone who has an account at one of the large commercial banks, you know they're not paying competitive rates on deposits. And so part of this is helping the banks is they have a lot more money than they need on deposit. They don't really want all this consumer money, so they're not aggressively raising rates, and yet they're pocketing the difference, and that's starting to make it appear that perhaps the banks are really strong here, but that's not the case at all. So why historically does an inverted yield curve tend to foreshadow an economic downturn? After all, one closely watched section of the curve, the gap between yields on 3-month bill and 10-year notes, has inverted before each of the past 7 recessions. Now, we've talked about how this is such a great indicator because at some point what happens is it leads to a credit crunch. And we'll look at some charts and go over this, but it slows down credit creation. And in a debt-based economy, you need an ample supply of new money, not only to create growth, but to pay off that old debt. So you need a constant supply and a constantly larger supply of new loans being originated. When short-term borrowing costs rise above long-term rates, it suggests that Fed policy has become too restrictive. No, what it suggests is the long end of the curve is saying, look, we don't buy the Fed's view that there's going to be a growth and inflation problem. So the Fed controls the front end and says, hey, you know what? We think growth is too hot. You heard them say that. We think inflation's too high. So we're going to raise short-term rates to bring those two down. The long end of the curve, which the Fed has no control over, is saying, look, we don't buy that narrative at all. We believe that growth is slowing and that inflation is coming down, and that's what causes a curve to invert. And so what we can see, it leaves the economy vulnerable to unexpected shocks, as well as the case during the pandemic. But as bank earnings show, the curve itself doesn't cause a recession. Now, something that shouldn't be experiencing an unexpected shock is your trading account, because if you signed up for CTA-Timer Pro, here we've got an update on our QQQ trade and what the report said. Down here, when no one wanted to buy this tech stocks, they thought they were going to go off a cliff. The report said, look, you should start taking a position here. We always recommend putting a stop loss on, and we say if it rallies, which it did, add into the position. And if you missed it or you wanted to add more, it said, look, you could do it right here. The report, once again, came out, and if you did all of that, you'd be way up here. And just the other day, as we'll look at in a moment, it signaled a point that is worth noting, because here back on January 9th, it was coming off the max short position. We said this is the time to look at buying. This is how you use a report. Here again on March 15th, what did it say? On that pullback, the machine started buying again, because what our report does is it looks at how the machines are positioned in the market, and then it runs a historical overlay, which is super cool. It tells you when things are at extremes, and when they're extreme low, as you see on the report from a negative, that's when you kind of want to look to be buying. And here you can see on July 11th, we saw the machines pull back a little bit, suggesting that either you should start taking profits, or as we like to suggest, just raise your stop loss levels up. There's a link in the description. It's $30 a month and comes with a 30-day money-back guarantee. On top of that, we just posted our weekend watch list to help you maximize your opportunities. So let's take a look at what we have the problem with this yield curve coming back to the banks and why it's not affecting them, well, just yet. And what we can note, the yield curve, that we're going to use the 10-year, 2-year, which is shown in red, 10-year yields minus 2-year. When it's inverted, it's below the horizontal black line, and we're going to put that against the net percentage of domestic banks tightening standards for commercial industrial loans of all sizes. Now that, when it gets tighter, is above the horizontal black line. So you'll notice as we see the yield curve get near zero, where the banks can't make money lending, they start tightening standards. And then as the curve further inverts, the banks tighten standards more. And a simple reason they do this is if you can't make money lending, why would you want to lend? So if you had a retail store and you had a product that you were going to sell at a loss, you would have a very simple explanation. Don't sell any of them. Don't take the loss. That's what you see at the banks here. Now, looking at the global financial crisis, we see the same thing happen. We see it going right into the pandemic when we're headed into recession. And now look, we see now the steepest curve inversion since the 1980s. And what do we know? That, of course, at the time it inverted, banks started tightening lending standards. The problem now coming back is there's still pandemic money in the system, which I think is the issue here. And now we have evidence it's completely dried up. And if you can only imagine, if incomes are down broadly 20%, that means there's a lot of people that are going to spend a lot less money in the real near future, and that'll bring inflation and a lot of other things down. Here we can see, because the issue comes right full circle back to the banks, because now when we look at tightening lending standards, we'll still keep that in blue. We're going to overlay commercial industrial loans, because what we want to see is, are banks still originating new loans and creating new money to keep the economy going? And when they tighten lending standards, well, what you see in red, which is a commercial industrial loan shown on a year-over-year rate of change, as lending standards tighten, banks still are originating loans, but then all of a sudden that starts to drop off. You see it again in the global financial crisis. And now look what's happening here. We're running around a 3% annualized rate, but the banks are still have to tighten standards even more, which we'll see in the coming quarters as we get new data. But what this suggests is that the rate this is going, that commercial industrial loans are going to turn negative, and what that leads to is a destruction in money. And in a debt-based economy, that's one of the last things that you want. You need a constant supply of new money being made into the system to pay again on those old debts and for growth. If you have money being destroyed because more loans are being paid off than originated, then we go back to that analogy of musical chairs, except now we pull away a few more chairs, and there's a lot of people lining up that when the music stops don't have the money to pay on their debts. And we can now look a little closer here at the yield curve against that federal government current tax receipts data, and we can kind of see how the two kind of go together. So now we're going to pull the chart back a little bit more, where we can see that bigger inversion back in the 80s. This was, again, the yield curve showing inverted below the horizontal black line. So we can note that when you see an inversion start to form, that eventually federal tax receipts come down. And we see that here again in the late 80s, tax receipts falling as the curve inverts. We see it here again going into the dot-com bubble. We see it here again going into the global financial crisis. And we're seeing it again now, because all it's doing is validating the banks aren't able to create money in an inverted curve. And eventually that leads to a broad slowdown of money creation. And what does it mean? Well, we can look a little deeper. We can see it against commercial industrial loans because we have a ton of data, and we can actually see as federal government tax receipts go down, it leads commercial industrial lending. So again, as people have less money, well, they can't borrow as much because the banks tighten lending standards, and the two start to go down together. This is a very dangerous relationship that's going to impact the banks. So they're celebrating now, but they're not going to be celebrating too much in the quarters to come. And how about against crude oil? Well, of course, we know crude oil is a great leading indicator of economic growth and across the world. And what do we see? Not quite the beautiful relationship we want to see, but we see somewhat of a trend that crude oil and federal current tax receipts kind of go together. As the year-over-year rate of change in crude rises, well, so does the federal tax receipts. And here we can see crude oil running at a negative year-over-year rate of change, suggesting that tax receipts are going going lower. So that means, of course, we know there's going to be bigger problems in the economy as, of course, tax receipts go down. We haven't even seen the effect of it. And that's kind of the point I wanted to make so far is as people have less money, that actually transmits out to the economy in the future, and we're not even there yet. How about in terms of new order demand? We'll look at that against federal government tax receipts. And what do we see? The new orders tend to start slowing down alongside tax receipts. So what this is suggesting that, again, that without any material pickup in new orders, which we're not seeing, at least out in China, and we're not seeing in the U.S., it means tax receipts, again, headed down. Not a good sign here. And how about what does this mean for the unemployment market? Well, it means a dangerous move and unemployment is coming. This is going to skyrocket higher because I want you to see as people, again, have less money to spend, well, you need less workers because they're not outspending that. And you can note as tax receipts come down, the 4-week moving average of initial claims goes up. You can see it happen each and every time. And many people now are saying, look, we just went through kind of a brief increase in initial claims. It's going to pull back. The chart and the data suggests not a chance. This thing's going to get worse. And yet economists are cutting back their recession expectations. Well, they might as well because they're usually wrong anyways, as easing inflation, a still strong labor market, and economic resilience led businesses and academic economists polled by the Wall Street Journal to lower their probability of recession in the next 12 months to 54% from 61% over the prior 2 months. But what we can note is even though this probability is high, it represents the largest month-over-month percentage point drop since August 2020. So more people are buying into the fact, well, it hasn't happened yet, so maybe the economy is actually pretty good and the Fed's got it right. Of course, we know that's not correct at all. And now pathway to achieve a soft landing or getting inflation down without recession is back on the table. That is completely the wrong view. We know the tax receipts are telling us otherwise. At the beginning of this year, it seemed more of a pipe dream. It seems a recession keeps slipping into the future, and that's causing these experts to lower their expectations of a recession. And yet what they don't see, what you've now seen, is, of course, the pandemic money's gone. Income tax receipts are coming down, less money being created, less money to spend, and this is just the beginning. And yet what they're worried about is inflation. Well, look at this. Federal current tax receipts in blue against the consumer price index in red. And other than this kind of mess here in the 80s, which at first it looked like the really issue was supply shocks causing some transitory inflation, look at the relationship now. Where tax receipts go, inflation follows, and for good reason. Again, if people have 20% less money to spend, well, that doesn't cause inflation. It causes disinflation and perhaps even deflation. But what does it mean for the economy? Because as far as these experts are saying, we're going to see a slowdown, but not a big one. Well, they got that wrong too. And here you can see on this chart the federal government current tax receipts against real gross domestic product. What a beautiful relationship these have as, of course, government tax receipts go down. We know GDP growth is headed lower alongside it, suggesting we have a lot further down to go in the future. And yet Citi gets credit card boost as borrowers start to struggle. Well, the first part is right. The second part, well, that's a big problem that's going to get worse for the banks. Amid a challenging macroeconomic backdrop, we continue to see the benefits of our diversified business model. Through trading clients staying on the sidelines, our card business has double-digit growth due to strong engagement or due to the fact that consumers couldn't keep up with inflation and you kept raising their limits, so they kept borrowing money until you're going to stop raising their limits, and then they're going to find out their spending is going to stop too, on top of the fact that their incomes are way down. And balances on Citi's U.S. credit cards swelled to $149 billion from a year earlier. Firm-wide credit costs soared 43%, fueled by write-offs as some cardholders fell behind. The firm added a mere $161 million in reserves. And what we can note is, of course, this is going to get a whole lot worse as, of course, more people head into delinquency and then default because they don't have the money. But is there one thing that suggests that maybe there's a turn coming? Well, that's the market. And here you can see in this chart the Wilshire 5000 price index, a pretty decent leading indicator of where federal tax receipts are going. Not perfect and not always right, suggesting that the market believes that everything's about to turn higher. Well, if this is indeed true and the pandemic stimulus is gone, the market is going to have a big reversal in the months to come once it figures out that consumers have no more money. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.